We're going to talk about the economy, the future of America, and much more. We're going to start with gold and silver. So I've been getting some comments and emails about your call about $2,500 gold and silver, $40 by the end of the year. When the new year happened, January 1st, what was your initial reaction to the price of both of these metals?
Well, what's interesting, David, is if I a couple of years ago said to you, let me paint a picture for you. We've had our second round of transfer payments to people that make less than 100 grand in the U.S. and they use that money to buy penny stocks and Bitcoin. And then the U.S. Capitol building has been overrun by protesters. Someone was killed, and things are on fire. And we're financing $3.5 trillion U.S. deficit at 0%. What's the gold price? You would have probably said, I don't know, 3,000 or 4,000, or something like that, and we're kind of stuck here at 2. So
that's a good point.
Look, I mean, yeah, we've been kind of scratching our head watching the action. I mean, yesterday you're at 1950, then you're down to 1900, and then now you're at 1920. I mean, there's a lot of day-to-day kind of takeout volatility is what we call it. And you see straight down, straight up, and a lot of people that are speculating, they end up in trouble. I've got a couple of coins right here. This is a Buffalo. In fact, someone actually gave this to me. He's probably watching the interview. It's a good friend of mine in Colorado Springs. That's a Metalla shareholder. We exchanged coins, and he sent them to me. But there's nothing like having gold. It's off the grid. It's out of the reach. I mean, nobody knows that this coin is sitting, right here. It's just there. It's not connected to anything. And I think as we move further down this path, people are going to start realizing, hang on a second, there's something special about this gold that's off the grid. It's real wealth. It's money. It's not an investment. Tell people that. They get very upset. But in my book, I tell them it's not an investment. It's money. It's an asset. Metalla is an investment. I got a Metalla hat because the stock was up 128% last year. And we printed up some of these hats. They're really nice. And gold was up 25%. The stock was up 128%. That's an investment. Okay, so when you look at gold, you don't want to be speculating saying, okay, I'm going to bet heavily that gold's going to do this or that. When we say it's going to go to 2,500 this year, how are you going to play that? Are you going to buy a coin for 2,000 and sell it for 2,500? Or are you going to buy a royalty company that has thousands of ounces in the ground? And when it goes to 2,500, all the value of those ounces gets pulled into today.
Here's my theory, EB, and you can correct me if you think I'm wrong. I think gold eventually will hit 2,500, maybe this year, maybe next year, who knows? But what we've seen over the last couple of months, if you take a look at the gold price chart, is a high around August and then a decline, a steady decline until maybe November, and then we saw a bounce back into the $1,900 range, which is where we are today. So, my suspicion is that a lot of people, institutions, retail investors, whatever the case may be, were taking their profits off of their August highs. And then as a vaccine rolled out, optimism kicked in, sector money rotation kicked in, people allocated more money into risk assets. And then now we're starting to see a bounce back into gold. So maybe you're off by 6 months.
That could be right. But the one thing I want people to see is that gold is a $12 trillion market. Okay. Yeah. So this is not like crypto. That's a $1 trillion market. It's very different. As you know, I think crypto is very interesting. It's not the same as gold. People say to me, is Bitcoin digital gold? And I say, no, it's not digital gold because gold is not physical Bitcoin. Okay. So you got to separate these two things. All right. So when you look at the gold market, David, the gold market is very big. It's very institutional. Countries, kings, wealthy families own gold. Okay. So the gold market tends to move up to a new level and then chop around and take money from speculative traders, okay, that are trying to gamble. And then once it's done, it moves to another level. You notice that did that at the 1,300 level, did that at the 1,500 level, did that at the 1,900 level. It's sitting there now. It's going to move up to another level, and it's going to do the same thing again. So what I encourage people to do is to say, okay, how are you going to play that? You're going to play that by buying tons of futures contracts and options and borrowing heavily and taking a second mortgage to bet on GDX options or something like that. And that's pretty risky. Okay. But if you look over time, this price moves up commensurate with destruction of your wealth in traditional government money. And so when people look at it like that, I think it makes a lot more sense. 25% for gold last year. I mean, since when is 25% not enough? I mean, what are people's other investments? I mean, Metal, 128%, that's different. But think about this. We live in a world where the bank pays you zero and then gold goes up 25% and people are upset. It's really strange times.
So what is a price that makes sense to you this year for gold?
We think as soon as the grinding is done at 1900, you pop up into the low 2000s and you hit 2500 next year. We were surprised that the rally to August didn't carry on. We felt like some of the fundamentals were in place for it to carry on, but we underestimated the pullback. But we see as soon as we're done at 1900, you notice we haven't made a new low. The low was earlier in the fall, and we haven't made a new low. So it's continuing to make higher lows. So that's what you watch on the chart.
The pullback caught a lot of people off by surprise. One of the theories that I've heard was that Bitcoin was stealing gold's thunder, and people have compared Bitcoin and gold. You brought a good point. If you put the two charts side by side, it does seem like capital flowed into Bitcoin away from gold. Now, I have my doubts. What are your thoughts?
Okay, so gold's an over $12 trillion market, and Bitcoin, we have to check it minute by minute because it's moving that fast. But let's just say Bitcoin is a $700 to $750 billion market. And again, you've got to realize that these two things are not interchangeable. It's not, Bitcoin is not digital gold. Gold is not physical Bitcoin. Okay, so they're different. They both have important properties. Okay. People are treating Bitcoin as wealth storage. Maybe that's true. Maybe it's not true. I think over the long run, they're going to be surprised that Bitcoin is far more on the grid than people realize. Okay, that's up to them to discover. But I'm not so sure that you can say that dollars coming out of gold and going into Bitcoin. I'm not sure that works. I don't think it holds up under analysis, and I also don't think it matters. When you look at gold, if you read in my book, we talk about how much gold should I own. It's the number one question people ask. And we give you a formula to kind of figure out what's right for you. It's a really small amount, actually. And the same could go for people that say, how much Bitcoin should I own? I get asked this question all the time. And I say, well, have you bought any? No, I want to know about it. Well, it's buy a gold coin, buy one of these, right? Buy a Bitcoin, what could possibly go wrong? So I think people are ideological is my point. They're getting into this ideological framework around Bitcoin that starts, to the guy with a hammer, everything's a nail. You look at the gold price has a correction and they say it's because of Bitcoin. No, it's not because of Bitcoin. It's not. These two things are mutually exclusive. And if you see that, you can make money off both. If you don't see that, you're probably going to just speculate and gamble and lose money.
I'm actually surprised at how conservative you are with your forecast today, because let's go over the drivers of gold. Right, monetary stimulus is still in place. Negative real interest rates are still here. The economy is still in shambles by most definitions. Recovery is underway, but it's not happening right away. What else am I missing? Inflation, is that coming? Yeah.
Okay, so I want everyone to pay close attention to what I'm about to tell you, because 5 years from now, you're going to look back and you're going to see that I was telling you something very valuable. Okay. The Fed has a 2% inflation target. You hear this all the time. They go on television, 2%. By the way, Fed chairman never used to go on television. When I was a kid, you wouldn't even know who the Fed chairman was. Okay, so now they're on television, 2%, 2%, 2%, and we've been below 2% inflation. So they're going to let it go above 2%. So they're going to let it go 3%, right? And they're going to say, well, we were 1% below for so many years. We're going to go 1% above. So 3% inflation. But really, if you're really woke, you're going to know that that's not right, because the way they calculate it excludes certain items. So it's really going to be 5% inflation. And so you're going to have 5% inflation that they call 3% inflation that's meant to be an overrun of 2% inflation. And all that's going to be happening at the same time that the economy grows at, say, 3 or 4%. Okay, so what do we know from economics? That's actually shrinking, because if you're really inflating at 5 and growing at 3, you're shrinking. And so the next few years, David, the average person is going to make a higher minimum wage. Okay, so they're going to make about $1 more per hour every year. They're going to think, this is great. I'm going to be making more money. But then slowly, everything that they do is going to cost a little bit more. Okay, taxes are going to be a little bit higher. because taxes aren't on the rich. Believe me, the rich have means to structure things to get around taxes to some degree to minimize the impact. Okay, the poor people don't have that. Taxes are going to go up on the average. Expenses are going to go up on the average. Okay, and the value of your money is going to go down. And it's going to take you some time to figure this out. This is exactly what they engineered after World War II to heavily indebted countries. It's exactly what they're trying to do now. It's a passive way to get rid of some of this debt that people aren't going to be upset about until later. If you're a politician, you love that. And if you're a Fed chairman, it gives you control of the system while that's happening. It's a very, very important concept. I hope everyone listening will realize it's not too complicated for you to understand. In fact, in my book, we break it down even in an even more simple format. And there's something you can do to get ahead of it.
Is that okay? Does that apply to private debt as well? Let's say, I'm not even on a corporate level, but like, on a retail level. If I go out and max out my credit card now, is that a good idea?
Well, most credit cards, I don't have a credit card. I have an American Express, so I'm not sure what the interest rates are because you have to pay the bill every month. But most credit cards, from what I hear, they have 20% interest rate. So it's going to be really hard for you to find something that inflates it more than 20%. I mean, some things do, but I don't think that's a good idea. Now, let me say something about personal debt, because probably in the future I'll write a book about people have asked me to do this about personal money, but debt is very difficult because when you have debt, you shrink down your frame of view. It gets very small. It's like a horse with blinders on. You miss things. And so to go out and buy something and borrow the money to buy it, you got to be really sure that it's going to increase in value. Okay, so if you could do that, then you can take that debt, and then the appreciation / devaluation will give you an extra boost on your investment. But the danger is, it's very dangerous, because if you do that on the wrong asset, you'll get trapped. So say you took out your credit card and bought Bitcoin. Okay, it was a really good idea, right? Because it worked out. But say you did that and you bought Ripple. It didn't work out so well. So I mean, you have to be careful, because you can buy the wrong asset. That's the danger. If you buy the wrong asset, then the whole plan is foiled. And so in my experience, it's better to leave that alone and find another way to play it. See, gold captures the devaluation of the money. Last year, it was up 25%. Gold's not really any more valuable. I mean, look, I got a gold tooth here. I think I told you this. I got a gold tooth put in. It's more expensive, okay? But the gold's not really more valuable. It just takes more dollars to buy it. So the gold is not an investment. It's not like with Metalla, where the company's royalties grow because the mining companies that are operating on them find more gold. That's an investment. So gold doesn't do anything. It's wealth, it's money, it's currency, it's another form of cash, okay? And why do you need that? Well,
that sounds exactly like Bitcoin, EB. Doesn't do anything.
That's what I'm saying. That's what I'm saying, except for Bitcoin. That's why I'm not negative on Bitcoin. In fact, I think it'll go quite a bit higher in price. But I think what people miss about Bitcoin is they think that it's this like hidden off the grid currency. That's something that they miss about Bitcoin. And it's like, you guys, I hate to tell you, but the kid that hacked all those Twitter accounts and got Bitcoin as ransom money, and he was in Florida last year, they traced that Bitcoin and found the kid. How do they do that? This is totally traceable. So, okay, once you understand that, you're good to go. Okay, you can understand you got to understand your investment, David. That's the problem. You can't go around like an idea, like gold bug. Everybody gives you a hard time about being a gold bug, is because gold bugs got a bad reputation for running around and shouting at people about how you're going to be using gold to buy groceries and all. They just completely miss the picture. It's not like that.
How much gold should we own then? Can you share your formula with us? It's in your book.
Yeah. So in the obviously I'm not a financial advisor, so I don't give personalized financial advice. But in the book, I break down this equation where I start showing a real example of a number like a 2% or 3% of net worth and what that looks like. And so when somebody looks at 3% of their net worth, they might say they're worth $1 million, 30 grand in gold, and they say, well, that's not that much. And it's like, well, yeah. I mean, how much fire insurance do you need? Not that much. I mean, it's got to be proportional. And so I think when people start thinking about things in terms of a formula, they start realizing that you can get your gold exposure, you can get your crypto exposure, and these don't have to be obsessive trades where you're checking them in the middle of the night and reading Reddit blogs about them all the time and arguing with people at family dinners about them. No. You get your position, you make sure it's something that works for you and doesn't keep you up at night, and then you move on. It's not a big deal. And if you do that, you end up making more money because you can think clearly.
Yeah. Is that dependent on your personal risk tolerance? So let's say, you hear that the younger person or a younger investor should have more risk or could have more risk and therefore less need for a safe haven asset. As you get older, near retirement age, you should do the reverse. Do you agree with that?
Well, okay. So look, so yeah, but if you're a younger person, you want to take risks in investments. Okay. So like Bitcoin is not an investment. Gold is not an investment. These are assets. Assets and investments are different. So if you're betting and you're speculating on the price of Bitcoin, that's fine, but don't call it an investment, call it an asset that you think is going to rise in value. An investment would be like in a royalty company. See, royalty companies, people don't understand royalty companies. They get this wrong, even on Kitco all the time. A royalty company gives you the chance to speculate on the metal price without owning an operating company and without having to have a futures contract and take on leverage. Okay, that's a very unique feature of royalties. Now, if you're young and you wanted to take risk, instead of putting 97% of your wealth into a Bitcoin or something, I would say like, look, you can use my formula in the book. You can have your gold, you can have your crypto, you can have operating businesses that you own that are going to grow. So look at businesses in the crypto space, businesses in the gold space that have improving business conditions when the asset price goes up. Does this make sense? Let me tell you, suppose corn was going to go to $12 a bushel. What would we do? We would buy the biggest farm possible. Okay, so we would grow as much corn as possible because we thought we were going to sell it for $12, instead of $4. Okay, that's what we would do. That's a business. So the economics of that business get better as the asset price goes up. That's how people need to think about this. Instead, they spend all day trying to argue with people about what the next crypto coin to buy or something. But it's like, listen, I don't care about Iowa corn versus Kansas corn. If the corn price is going up, I want to be in the corn business.
Royalty companies, misconceptions around those. Can you clarify those misconceptions for us? Now, you mentioned just now that royalty companies have unique attributes. So my question is, why invest in royalty companies? Why not just invest in the metal? Because it doesn't, why go through that extra layer of management?
Okay, so a royalty is a free interest, a free carried interest in a mineral asset that's free of dilution and free of operating risks. What that means is that 1% of the gold, here's an ounce of gold, 1% of all the gold on a property, okay, is belongs to the royalty company now and forever, 100 years from now, regardless of who's in business or whatever. So the difference is that if that company finds more gold on the property, if the gold price goes higher, you capture all those benefits without having to invest any more money. So the problem is the gold is that if you buy too much gold, okay, so last year you bought too many of these and you made 25% and you're happy about that. But Metallica's got 62 royalties, okay? So they have thousands and thousands of ounces of gold in the ground that are going to come out in the future. And every single one of those ounces is worth 25% more, okay? And you capture that value today. So what happens is it gives you this exposure to a much larger pool of future gold production at higher prices today. And that's why with gold up 25%, metal up 128%. So royalty is a way to leverage yourself to higher metal prices without taking on actual leverage, if that makes sense. Whereas if in the futures market, you're having to take on lots of risk. If you have a short-term dip, you're in big trouble. You have too much leverage. You borrowed too much. You're in trouble. With a royalty company, it's not like that. You have if the royalty company is doing a good job of acquiring assets, okay? And that's what people don't understand is that when the royalty company, you actually don't want the royalty company to be gushing profits today. You want them to have gold that's going to be coming out of the ground over a long period of time. Because if the gold price is going to go up 25%, the ounces you produced last year went out the door 25% less than they're going out the door this year. Okay, so you'd rather see gold production next year or the next year or the next year and not as much today. And people generally miss that.
All right. EB, thank you so much for coming on the show today. That was fantastic. Thank you for your thoughts.
Okay, thanks, David, and we'll talk soon.
We'll talk soon, for sure. Absolutely. Thank you for watching Kitco News. I'm David Lynn.